All right, so let's dive into this S&P Global's stock and like its potential future.
Okay.
You've given me this interesting article from The Motley Fool.
Mm.
It's from today, February 25th, 2025.
Okay.
And they're asking, where will S&P Global stock be in 5 years?
Yeah, that's a question a lot of people are probably thinking about.
Exactly. So we're going to explore their analysis. And by the end of this deep dive, you'll have a much better idea of whether S&P Global might be worth adding to your portfolio.
Sounds good.
And, as always, just to be clear, we're not giving financial advice, just breaking down the info and, having a conversation about it.
Always good to keep in mind.
So to kick things off, who is S&P Global, and why should we even care?
Well, they're kind of a big deal in the financial world.
Okay.
They're a major player in financial services.
Mm-hmm.
I think credit ratings, data analytics, the kind of info that CEOs and huge companies use to make big decisions.
Okay, so they're behind the scenes but super influential.
Exactly. And they're not just one of many doing this. They're part of a duopoly with Moody's, meaning they're basically the top two in the market.
Interesting. So if a company wants a credit rating, they pretty much have to go to one of these two.
Pretty much. It's like the Coke and Pepsi of the financial world.
Okay.
And to stay on top, they're even jumping into things like artificial intelligence.
Oh, wow.
They have this new tool called Spark Assist that uses generative AI to help with a lot of tasks.
Wow. So they're not just sticking with the old ways. They're getting into the cutting edge.
Right.
What does that actually mean for them, though?
Well, it could mean faster analysis,
Yeah.
more efficient use of their data, maybe even new products and services we haven't seen before.
Okay.
But it's a pretty new development, so it's definitely something to watch.
Definitely adds another layer to their story.
Yeah.
So with all that said, how have they actually been performing? The Motley Fool article mentions some pretty impressive growth.
Yeah, from 2019 to 2024, their revenue grew at an average rate of 16% each year, while their earnings per share, or EPS, grew at an average of 8% each year.
Okay, so before we go any further, can you break down earnings per share a little bit?
Sure.
I feel like people throw that term around a lot, but it can be
Yeah.
kind of confusing.
Absolutely. It's a key metric that tells us how much profit a company is making for each share of its stock.
Okay.
Think of it this way. If a company is a pie, EPS, tells us how big of a slice each shareholder gets.
I like that, a profit pie. Okay, so their profit pie slices have been getting bigger,
Right.
but the article also mentions some bumps in the road, right?
Right. You see, in 2022 and 2023, things got a bit rocky because of rising interest rates.
Okay.
You know how everyone talks about interest rates going up and down? Well, when those rates go up, companies borrow less money, which means fewer companies need credit ratings.
Right.
And that directly hit S&P Global's bread and butter.
Makes sense, like a chain reaction. So higher interest rates meant their profits took a dip.
Exactly. Their net profits, which is what's left after all their expenses, did go down during that time. Plus, they also decided to sell off their engineering solutions business in May 2023, kind of like cleaning house and refocusing.
A pretty big shakeup. So how did they bounce back from all that?
Well, good news is, in 2024, their profits started climbing again as interest rates cooled down, and the effects of selling that business settled in them. They're showing some resilience, which is a good sign for investors.
Okay, so they've weathered some storms but come out on the other side. But now the question everyone's waiting for, what's the forecast? What does the future hold for S&P Global?
For 2025, they're saying they expect revenue to grow between 5% and 7%.
Okay.
Solid. But what really stands out is their projected earnings per share. We're talking a potential jump of 73% to 76%.
Wow. Those are some seriously big numbers. That 73, 76%, is that taking everything into account?
Well,
Or is that just focusing on certain things? I think that's where those terms GAAP and non-GAAP come in.
oh, got it. JAP, or generally accepted accounting principles, basically means they're including all the usual stuff when calculating earnings, revenue, costs, taxes, the whole shebang.
So that 73, 76% is like the full picture of their potential profit growth per share using all the standard accounting rules.
You got it. But sometimes there are one-time things that can make that number look extra big or small.
Okay.
Maybe a big expense for selling off a business or a one-time tax benefit.
Gotcha. So then what does it look like if we take those one-time things out of the picture? What's the non-GAAP projection?
Still very strong. We're looking at 35% to 37% growth. So even with a more conservative view, their potential is pretty clear.
All right, so we've got those huge potential jumps in earnings per share.
Right.
But of course, we also have to talk about valuation. Just because a company's earnings are growing doesn't mean it's a good deal for investors, right?
Okay, so the big question is S&P Global stock actually a good deal at its current price?
Okay.
It's currently trading at 37 times its projected 2025 earnings per share using GAAP,
Okay.
and 31 times the non-GAAP estimate.
Okay, I'm going to need you to unpack that for a second because I know that's super important for investors. What does it actually mean for a stock to be trading at, say, 37 times its earnings?
It's all about how much you're willing to pay for each dollar of a company's earnings. So in this case, investors are paying $37 for every $1 of S&P Global's estimated earnings in 2025.
Right.
And some might look at that and say, whoa, that sounds pricey.
Yeah, I can see how that could raise some eyebrows. But the Motley Fool seems to think this price is actually justified. Why is that?
They argue it's justified for a couple of reasons.
All right.
Firstly, they believe that S&P Global's earnings will continue to climb as interest rates decline and the economy stabilizes.
So basically, a better overall economic environment is expected to boost their earnings even more.
Exactly. And the second reason is S&P Global is doing something interesting called share buybacks. It's a strategy where a company uses its own money to buy back shares of its own stock from the market.
And what's the impact of that? Why would they do that?
It's like they're making their profit pie smaller, but cutting it into fewer slices.
Okay.
Fewer shares outstanding means each remaining share represents a bigger portion of the overall company. This boosts earnings per share, making the company look more profitable on a per-share basis.
Okay, so it's a way for them to boost their earnings per share and potentially make their stock more attractive to investors.
Exactly. It shows they're confident in their future and taking action to enhance shareholder value.
Very interesting. It's all starting to click into place. But let's zoom out a bit and talk about the longer-term outlook. What are things looking like beyond 2025?
All right, this is where things get even more interesting. Analysts are predicting a 7% average annual growth rate for revenue and a 14% average annual growth rate for GAAP earnings per share from 2024 to 2027. But the Motley Fool, they take things a step further with a pretty bold prediction.
Okay, I'm on the edge of my seat. What's this bold prediction?
They painted a best-case scenario where S&P Global stock could reach $931 per share by 2030.
Whoa, that's almost a 75% increase from where it's at now.
Right, but of course it's based on a few assumptions. They have to keep their leading position in the market, maintain a 10% average annual growth rate for GAAP earnings per share from 2027 to 2031, hold on to their current valuation level, that 37 times earnings thing we talked about.
So a lot has to go right for that scenario to play out. But even if some of those assumptions don't quite pan out, the Motley Fool still sees some potential, right?
Absolutely. Even with a more conservative scenario, they're talking about a potential 25% increase reaching around $665 per share by 2030. Not a bad outcome at all.
Definitely something to consider. But we can't forget about something else that's important to many investors, especially those who like a little extra income: dividends. What's the situation there with S&P Global?
Well, their forward dividend yield is currently a modest 0.7%. Not exactly a huge payout, but there's something else that makes them stand out. They're a Dividend King.
The Dividend King, what does that even mean?
Think of it like royalty in the dividend world. It means they've increased their dividend payouts for 51 years in a row.
Wow. Talk about consistency. That's a pretty clear signal they're committed to rewarding their shareholders.
Exactly. And there's more good news. Right now, they're only using 20% of their free cash flow, basically the cash they have left over, after covering their expenses and investments to pay those dividends. So that means there's still plenty of room for them to increase those payouts in the future.
So even though the yield is small right now, there's potential for it to grow over time. Not a bad deal for investors who like those regular dividend checks.
Right. It could be a nice bonus on top of any potential stock price gains.
All right, so we've covered a lot of ground here: their business, recent performance, future projections, valuation, even dividends. But I think it's time to pause here and really let all this information sink in. We'll come back and talk about what this all means for you and your potential investment decisions.
Looking forward to it.
Awesome. See you soon. All right, welcome back. So far, we've been talking big picture about S&P Global, their business, their potential. But now I think it's time to get a little more granular and really dig into those numbers.
Yeah, sounds good. Let's revisit their financial performance over the last few years.
Okay.
As we mentioned before, the Motley Fool article highlights that impressive revenue growth, a 16% average annual growth rate from 2019 to 2024, and they also had that 8% average annual growth rate for their earnings per share, or EPS. Remember, EPS is like measuring the size of each profit pie slice for shareholders.
Right. And we talked about how EPS is a pretty important metric for investors. So they're seeing solid growth in both revenue and profitability.
Right.
But I think what makes this deep dive even more interesting is that it's not all just smooth sailing, right? There were some bumps along the way.
Exactly. It's not always a straight line upwards.
Yeah.
If we zoom in on 2022 and 2023, we see that their net profits actually declined. Remember, net profit is what's left over after all the expenses are paid.
Yeah, and we talked about how rising interest rates played a role in that fewer companies borrowing money meant fewer companies needing those credit ratings from S&P Global.
It's like a ripple effect. Changes in the broader economic landscape can have a real impact on specific businesses, even those as large and influential as S&P Global. That's why it's so important to understand the context behind the numbers.
So even though their profits dipped, it wasn't necessarily because they were doing something wrong. It was more about external factors they couldn't control.
Precisely. And to their credit, they didn't just sit back and let those external factors dictate their fate. They adapted. They streamlined their operations, even made the bold decision to sell off their engineering solutions business in 2023.
A bold move indeed. So essentially, they were streamlining and refocusing to weather the storm.
Right, and that seems to have paid off. In 2024, as interest rates started to stabilize, we saw their profits rebound. They're demonstrating resilience, which is a very positive sign for investors.
Definitely a sign of a company that can adapt and pivot when needed. Okay, so they're coming out of a challenging period with some momentum. What are the analysts saying about their future?
Well, for 2025, they're projecting revenue growth of 5% to 7%. That's respectable, but what's really grabbing attention is their projected EPS growth. We're talking a potential jump of 73% to 76% on a GAAP basis.
We talked about those eye-popping numbers earlier, but it's worth repeating 73% to 76%. Even if we take out those one-time events and look at it on a non-GAAP basis, it's still a projected 35% to 37% growth. Those are some serious gains, and they definitely make S&P Global a company to watch.
Absolutely. But as we always say, past performance is not a guarantee of future results. So what are the factors that are fueling these optimistic projections? What's making analysts so bullish?
I'm glad you asked. Several things seem to be working in their favor. Firstly, most analysts expect interest rates to either continue declining or at least stay relatively stable. This creates a more favorable environment for companies to borrow money, which in turn boosts demand for those credit ratings that S&P Global provides.
Right, so they stand to benefit from those anticipated tailwinds in the economy.
Right. Exactly. And on top of the favorable economic outlook, S&P Global is taking proactive steps to enhance their earnings. We talked earlier about those share buybacks, where a company uses its own funds to buy back shares of its stock.
It's a classic strategy, and it can be quite effective. By reducing the number of shares outstanding, they're essentially increasing the ownership stake of each remaining share.
It's like concentrating the flavor, making each slice of that profit pie richer. It's a pretty clear signal that they're confident in their own future and they're putting their money where their mouth is.
Right, and that confidence is reflected in those bullish long-term projections we talked about earlier. Analysts are predicting a 7% average annual growth rate for revenue and a 14% average annual growth rate for GAAP earnings per share from 2024 to 2027. Pretty impressive.
Don't forget that the Motley Fool even painted a best-case scenario where S&P Global stock could hit $931 per share by 2030. That's a potential 75% gain from where it is today.
A very tantalizing prospect for investors. But it's important to remember that this is a hypothetical scenario based on a number of assumptions.
It's not a guaranteed outcome by any stretch, but it does illustrate the potential upside if things go their way.
And even with a more conservative outlook, they're still projecting a potential 25% increase, reaching around $665 per share by 2030.
Not too shabby at all. And we can't forget about those dividends. Even though the current yield is modest at 0.7%, their status as a Dividend King makes them very appealing for those who appreciate a steady income stream.
And the fact that they're only using 20% of their free cash flow for those dividends suggests they have room to increase those payouts in the future.
It's a compelling combination. A company with a strong track record, a positive outlook, and a commitment to rewarding its shareholders through dividends. But before we get too carried away with all this optimism, I think it's crucial to take a step back and consider the risks. No investment is without its potential downsides, and S&P Global is no exception.
You're absolutely right. It's all about balancing optimism with a healthy dose of realism. So what are some potential pitfalls that investors should be aware of when evaluating S&P Global? What could go wrong?
Well, for one, their business is heavily reliant on the health of the global economy. Their fortunes are tied, to some extent, to the broader economic tides. If we were to experience another major economic downturn, demand for their services could decline, which would impact their revenue and earnings.
That's definitely a key risk to keep in mind. Economic downturns are a reality, and S&P Global wouldn't be immune to their effects.
Right. And while their duopoly with Moody's gives them a commanding position in the market, it's not an impenetrable fortress.
Yeah.
Competition could heat up, potentially squeezing their profit margins and putting pressure on their pricing power.
It's like that old saying, it's lonely at the top. We've seen disruptors emerge in many industries, and the financial services sector is no exception. Keeping an eye on the competitive landscape is crucial.
And then there's the regulatory environment. S&P Global operates in a highly regulated industry, and any changes in regulations could have a direct impact on their operations and profitability.
You're highlighting some very important points. Investing always involves uncertainty. It's about weighing potential rewards against potential risks, and S&P Global, despite its many strengths, is not immune to those uncertainties.
It's about informed decision-making. Investors need to understand the company's business model, its growth drivers, and the potential headwinds it faces to make smart choices that align with their investment goals and risk tolerance.
Exactly. We've provided a lot of information and insights in this deep dive. We've explored S&P Global's history, their financials, their projections, and even the potential risks. But now it's time to bring it all together and ask that crucial question. What does this mean for you, the listener?
That's the heart of it all. How can we take all this information and distill it into actionable insights that can help you make more informed decisions about your own investment?
That's the goal. We want to empower you with knowledge, not just to entertain you with numbers. So let's shift gears and explore those implications.
All right, welcome back to the deep dive. We've been on quite a journey with S&P Global, exploring their impressive growth story, but also acknowledging those inevitable bumps in the road.
Yeah, we've dug into their financials, analyzed their growth prospects, and even contemplated those attractive dividends.
We've tackled the tough questions, assessed the risks, and emphasized the importance of aligning your investments with your personal goals.
But now let's shift gears and bring it all home. What does this all actually mean for you? How can you use this information to make smarter investment decisions?
Because at the end of the day, that's what this deep dive is all about. It's about empowering you with knowledge, not just throwing numbers around.
Exactly. So let's say you're intrigued by S&P Global. You've seen their track record, you get their business, and those growth projections have definitely caught your attention. What should your next steps be?
First and foremost, never base your investment decisions solely on what you hear on a podcast. Always do your own research.
Couldn't agree more. Think of this deep dive as a starting point, like a friend giving you a restaurant recommendation. You wouldn't just blindly walk in and order right. You'd probably check out the menu, read some reviews, maybe even peek at some photos online.
Exactly. Take this information as a springboard and dig deeper. Read the full Motley Fool article, dive into S&P Global's financial statements, even seek out different analyst perspectives.
And just like with that restaurant decision, there are some key questions to ask yourself when considering S&P Global.
Okay, let's break down those questions. What's at the top of the list?
Alignment with your investment goals. What are you actually hoping to achieve with your investments? Are you looking for long-term growth, a steady stream of income, or a bit of both?
Because S&P Global, with its potential for both capital appreciation, meaning the stock price going up and those consistent dividends, could be a good fit for investors who are looking for a balanced approach.
Right. But if you're more interested in high-growth, high-risk stocks that might double or triple in value overnight, S&P Global might not be the right fit for you.
It's all about finding investments that align with your individual goals and timelines. And speaking of individual factors, we can't forget about risk tolerance. How comfortable are you with the ups and downs of the market?
That's crucial. As we discussed earlier, S&P Global is not without its risks. Their performance is tied to the global economy. Competition could intensify, and those regulatory changes could impact their business.
So if you're someone who prefers investments that are less volatile, less sensitive to market swings, S&P Global might require some careful consideration.
Absolutely.
Yeah.
And here's another classic piece of advice. Don't put all your eggs in one basket.
Diversification. It's one of the golden rules of investing.
Exactly. Even if you're feeling super bullish on S&P Global, it's important to spread your investments across different asset classes, different sectors, different geographies. Diversification helps to manage risk and build a more resilient portfolio.
So think of it like building a well-balanced meal. You wouldn't just eat one type of food, right? You'd want a mix of protein, carbs, veggies, different ingredients working together to create a healthy whole.
Exactly. A diversified portfolio is like a well-balanced meal for your financial health. Now, remember how we talked about S&P Global's role in ESG ratings?
Yeah, it's a fascinating aspect that we only briefly touched upon.
Right. So As you're doing your research, I encourage you to dig deeper into how those ESG factors, environmental, social, and governance, are shaping S&P Global strategy.
It's a rapidly evolving field, and it could be a significant growth driver for them in the years to come, or potentially a source of challenges as ESG standards and expectations continue to shift.
Exactly. It's all part of that bigger picture assessment that you as an informed investor need to consider. It's not just about the numbers, but about understanding the broader trends that are shaping the market.
And speaking of getting help with that bigger picture, don't be afraid to reach out to a trusted financial advisor.
The financial advisor can help you assess your personal circumstances, your goals, your risk tolerance, and provide tailored advice that's specific to your needs.
Remember, this deep dive is meant to give you information insights and a framework for thinking about your investment decisions. But the ultimate choice rests with you.
So there you have it, our deep dive into S&P Global. We've explored their past, present, and potential future.
We've analyzed their financials, their growth prospects, and considered those attractive dividends.
We've tackled the tough questions, assessed the risks, and highlighted the importance of aligning your investments with your personal goals.
We hope this deep dive has been informative, engaging, and maybe even sparked some new ideas for you.
And as always, we encourage you to keep exploring, keep asking questions, and never stop learning.
Because in the world of investing, knowledge truly is power.
Until next time, happy investing.